Could this be the bottom of the Chinese stock market rout? Because you're looking at Alibaba ripping higher around 5% on the Hong Kong exchange. 9988 is the ticker on the Hong Kong exchange. Tencent as well, also jumping over 5%. So broadly, Chinese stocks ripping higher on the news that the Chinese government, is considering a nearly $300 billion stock market rescue package. And so this would entail them taking 2 trillion RMB from the accounts of Chinese state-owned enterprises, so the Chinese state-owned businesses, taking the money that they have offshore and saying, hey, you're going to take your funds and buy shares on the Hong Kong exchange of these stocks. We want to balance and shore up the market. This is potentially a bazooka for the Chinese stock market, looking through the Hong Kong exchange. And this follows their prior steps just, I believe, last week or earlier this year, where they were looking at their largest broker curbing short sales, making it harder for stocks to go down by saying, look, individual investors and institutions, we're going to make it harder for you to, let's say, loan out your stock to, potentially, give cause for short sellers, or give the opportunity for short sellers to sell your stock. We're trying to create a situation that's favorable for the shares to rebound. I personally don't agree with that sort of approach. But looking at, how deep this route has gone, I mean, looking at Alibaba, it has given up all of its gains, since it's IPO'd. It is underwater by 20-30%, despite the fact that the underlying business has continued to grow. You look at just year to date in KWEB, which is a Chinese internet ETF. This is down nearly 14% as of the close today. And so this shows you this was an accelerating problem. 14% in just the first couple of weeks, first few trading days of this year suggests a worsening problem. So you might be wondering, why is this happening? I think in addition to all the challenges that the CCP is sort of self-inflicted, it partly got worse recently with the Democratic election of arguably the candidate that is least favored by the CCP in Taiwan, which is the Democratic Progressive Party president being reelected. So that was the perspective of, could this create greater risks of China moving by force to reclaim Taiwan, which is something they've repeatedly said. And then you see in the U.S. perspective, the odds of a Trump reelection have arguably, inched higher for 2024, and he would consider reapplying pressure on with China, making that U.S. relationship, U.S.-China relationship even worse. That could, make the Chinese economy even worse. So you're seeing these dynamics. I think these two key developments are part of the reason why you've seen this accelerated sell-off in Chinese stocks. The question is, where do we go from here? Because with investing, it's not just backwards looking. You want to be thinking about, where could you be in 6 months, a year from now, 2 years from now? First of all, in full disclosure, this is not financial advice. Also, quick plug, if you're looking for compelling investment ideas, consider Unrivaled Investing, which includes a weekly letter and my personal portfolio updates in real time. We also have an exclusive Discord community where I will personally let you in and discuss your questions, available exclusively for premium annual subscribers. There's also educational materials as well at unrivaledinvesting.com if you want to think about, how do you read financial statements or value a stock. That's also there. So thinking about Chinese equities right now broadly, I mean, it's interesting. You see this additional piece from Bloomberg talking about how with the recent sell-off of Chinese stocks relative to U.S. stocks, U.S. stock market has a valuation of $38 trillion more than Hong Kong and China put together. So the value of U.S. stocks, there's a $38 trillion gap in terms of how much of a premium people are willing to pay. Now, part of this is definitely warranted. You don't have to have the same amount of concerns that you have, let's say, that the CCP is going to say, hey, you have to pledge your profits to XYZ in the future. And, there's this rule of law that's understood. So this is definitely, part of the premium is definitely warranted. Now, you think about the valuation and, not only does it translate into trillions of dollars more, but it's also just a fraction of the PE multiple. So you're effectively trading at a 60% discount on a PE multiple basis, just looking at where the US is trading versus where, let's say, China and Hong Kong on a PE basis. So looking at a, significant discount. Where the S&P 500 trades, over 20 times, 22, 23 times, you're talking about a more than 50% haircut in China. So if you were to run it through AI ticker chat to think about, okay, how could this stock return in the future? Through a feature like AI Predict, where it's, saying, hey, here's a range of possibilities, for this stock. And for something like Alibaba, it's showing, look, if you get, reasonable single digit growth or maybe even low teens, and you have some sort of rebound in profit margins, along with a range of market multiples from 15 times to 25 times, you could have a scenario where the stock is up several 100%. So that is something I'm going to, pound upon, which is that it would not surprise me to see a scenario where many of these Chinese stocks are significantly higher in the future, up over 100% in a quick period of time, just because you're considering something where the valuation has gotten so compressed, sentiment has gotten so bad that if you just deliver some very reasonable results without any sort of extreme execution, you could have tremendous upside. If I were personally looking to invest on the Hong Kong exchange, if I were looking to, try to find these hidden bargains, I would consider, buying directly on the Hong Kong exchange if I were looking, for bargains there. And I would personally use Interactive Brokers, which allows me to buy, on individual exchanges, many countries around the world. See the link below for Interactive Brokers. The reason being is that if, in theory, that there's some sort of geopolitical tension where they, the domestic government might say, hey, you can no longer own, let's say, the ADRs of XYZ country or security, that could be a painful position. Whereas in theory, if you owned it on the local exchange, it might not be as much of a problem, because they can't necessarily say, hey, you can't own the Hong Kong shares. You just can't own, we're not going to allow, let's say, the US ADRs to trade. So that is a possible scenario. And that's the reason why, with the geopolitical tensions flaring the last few years, when I've considered buying Chinese stocks, I've done it on the Hong Kong exchange. Look, you could say you disagree, and if one is going to get frozen, the Hong Kong shares will also turn into a pain, but I'd rather, sort of own it directly on the exchange. So once again, that's using Interactive Brokers. I also, broadly looking at Chinese stocks, even though it wouldn't surprise me if they are 100, 200% higher in the next year or so, just because of how bad sentiment has gotten, I just don't like spending time thinking about, well, what's the CCP going to do? And arguably the latest development is favorable for shareholders. The, $300 billion stimulus to buy stocks, create a buy or a bid that could lift stocks higher. But I just don't like that they've deviated so far from what has worked for their system, which is, capitalism with Chinese characters. And there's been this change, arguably, over the last few years, and that's just, it makes me uncomfortable. So for me, it's a pass, but once again, it would not surprise me at all to see this much higher. And I think it's super important, and it's based on, I just don't want to be thinking about the CCP on a daily basis. This is more of a mental health aspect. I just don't want it in my head. And this gets to the point where every investor is going to have a different journey. But I think it's a little naive to say, well, wait a second, I don't want to own Chinese stocks and therefore limit my China exposure. And this is an argument I've heard many times before, and I think it's worth calling out. Because if you're an investor in NVIDIA, for example, historically, half of their sales were between Taiwan and China. So if there is a concern with China, a geopolitical concern, let's say with Taiwan, that's going to have a huge impact on a business like NVIDIA. This has been one of the stock market's favorites. Look at Apple, another $3 trillion company. NVIDIA, I think, is $1.5 trillion company. Looking at Apple, something like 70%, it's between 60 and 70%, the estimates, at least when I asked AI Ticker Chat, of how much of their manufacturing is going through China right now. So if there's some sort of problem, this is going to have a huge impact on all companies, on all U.S., on many of U.S. companies, the largest companies. So it's important to recognize how intertwined these economies have become. And this is not even, going into the fact that there's such a choke point around the chips that are coming from Taiwan, which is that if you want the latest cutting edge technology, you need to get it through the chips that are manufactured by Taiwan Semiconductor. They have a monopoly position. I previously covered Chip War. That is a fantastic book. It covers this dynamic. They've achieved it. Over 50%, market share of the leading cutting edge chips. It'll likely be that way for at least the majority of this next decade. And that means that if there's any sort of issue between China and Taiwan, that's going to have an issue for everyone that needs those chips, which, by the way, is every leading company that uses, cutting edge technology, cutting edge chips, with physical hardware. So this is broad-based with the largest companies. And look, it's not just, consumer goods. It's not just, consumer hardware. It's not just, cutting-edge technology. Look at Starbucks. I go to AI Ticker Chat. I'm curious, what is their exposure to China? I select the 10K, and it quickly calls out, look, China is a major profit center for Starbucks. It is the fastest growing market in terms of percentage growth. It's also their second largest market overall for the company. I mean, that is just incredible. And so this isn't just cutting edge chips that would be impacted by a geopolitical issue with US China going head to head. You do not want that to happen. And so I think it's important to understand, like, Chinese stocks have gotten so battered, you don't want to see them go to zero. If something like that were to happen, you would see all these other stocks dramatically hurt as well. And so that's a super important point to think about. And look, just because, it could rally 100, 200% easily from here, once again, doesn't matter if it's something that's not appealing for your own personal journey. And that's something I repeatedly talk about, with my subscribers at Unrivaled Investing, is that everyone needs to figure out what they're comfortable with. What are the types of risks, the challenges, the things that they want to own, the future that they want to bet on. And for me personally, thinking about the CCP just bothered me too much. So I'm not going to cry and say, like, oh man, I'm really disappointed when or if it rips significantly higher and saying, oh, I missed out on it. I'm okay with that. Partly because, as my subscribers know, I'm looking for companies that trade at, China level valuations like you're seeing right now, where you don't have the CCP risk. You might trade it off with something else. And my top two holdings arguably each have a China type valuation, so you have that sort of valuation tailwind that can, cause it to rip higher in the years ahead. But I just don't want to deal with, is the CCP going to force my holding to, pledge like 15 trillion or $15 billion like it did with Alibaba, a year ago. Said, you're going to contribute to society and make sure, the prosperity pledge. And so every investor journey is different. You need to figure out what's right for you. I think it's important to recognize that these Chinese stocks are, if there's the good chance that they rebound just because of how much they've sold off. And that saying, hey, I'm not going to own them because I don't want China exposure, is sort of naive, given that if you own Nvidia, you own Apple, you own Starbucks, you own anything that is manufactured by TSMC and is reliant on it, that you own companies that are deeply enmeshed with this relationship. So it's worth understanding and reflecting on. I hope this video has been helpful for you. I encourage, your commentary. I like to have a dialogue here below in this YouTube video. And thanks so much for tuning in.